We're entering the last explosive phase of the crypto cycle, and today I'm showing you exactly how I'm playing it. Firstly, I'm going to go through my portfolio construction for the next leg of the cycle. Then I'm going to talk about how I'm planning on exiting the cycle. And then lastly, I want to talk about the mental framework that may seem slightly counterintuitive, but is actually the secret to nailing this last part of the cycle. So if that sounds good, make sure you do subscribe to the channel. This is a brand new channel called Crypto Edge, where I'm filming alpha-packed, bite-sized videos for you to be able to level up your crypto game and get the edge on the rest of the market. Without further ado, let's get into part one, structuring my portfolio. So in terms of portfolio construction, I like to keep things quite simple in my head. I don't like these complex, convoluted portfolios. Instead, I've broken it down into a simple framework. 80% goes into my core portfolio. These are safer assets like Bitcoin, Ethereum. I have some bets like Solana, Pump Fund, Hyperliquid, ENA, Mantle, the core portfolio, which makes up the majority of my capital, around 80%. Then I have the 20% of my portfolio. This is where I have my fun. These are the riskier bets, those moonshot plays which could potentially deliver 10 to 20x gains. But with this part of my portfolio, I'm willing to accept the fact that I might lose money. I'm spraying and praying, I'm degenning, I'm taking on a lot more risk. So I treat it very differently from that core 80%. Now in this 20% of my portfolio, right now at the time of recording this video during September, I've actually been DCAing into some riskier assets across sectors that I think at some point could perform really well, like robotics, AI, RWA, collectibles, narratives that I think will be strong heading into this final phase of the bull run. I'm actually looking at a lot of lower caps between 10 mil and 100 mil in market cap that could potentially deliver really strong gains in this final phase. But the DCAs that I'm making now into these riskier plays, I'm fully aware of the fact that they could go to zero. I am willing to burn my money with these DCAs in pursuit of higher beta exposure to the market if things really pop off. If I'm wrong and they don't pop off, at least I still have that 80% core portion of my portfolio, which is likely to perform a lot better during a market downturn or at least during a muted cycle. That 20% is the way that I get asymmetric upside to the market. The 80% is the way that I, at least to the best of my knowledge, guarantee making money in this cycle. Now, there's actually a key point I want to get across here, and it's the fact that you don't actually need to be fully allocated in the market at all times in terms of spot exposure to make huge gains in the crypto market. In fact, because 80% of the gains happen in the last 20% time-wise of the cycle, so many opportunities open up during this phase of the bull run, whether it be trading, whether it be new narratives, whether it be asymmetrical opportunities in other areas of crypto. Opportunity comes when the market is liquid and when the market is bullish. So even if theoretically you owe 100% in stablecoins, if you pay attention and you're focused, there will be so many opportunities which come around because of that. Now, I don't go 100% in stablecoins. I still have this 80-20 portfolio, but that 80-20, I'm talking about my token exposure to the market. I also hold stablecoins, which are representative between 30 and 50% of my overall net liquid worth in crypto, which I use to DCA into the market or look to trade and take opportunities as the bull run evolves. I think it's important to acknowledge this, because so many creators are going to talk about being all in and how they're always invested. But the reality is you actually do need liquidity to take advantage of opportunities in the market as they come, both on dips and during crazy periods of the market where you'll look to capitalize on momentum and the narratives that arise as a result of the bullish market conditions. All right, now let's get into part two, which is my plan to exit. I'm going to keep this short because I already did a full video on my exit plan, but basically the way I think about exiting the market is in two frameworks. The framework of how to take profits on the way up and the framework of how to invalidate on the way down. Firstly, on the way up, what I look to do is take incremental profits on altcoins and on my major positions as well at predetermined levels. So if I hold Solana, I've already determined that at 250, 300, 350, and 400, I will take out, let's say 10% on the way up. With a riskier altcoin where it's harder to have defined price targets, I might say, all right, every time it goes up a 2x, I'm going to take 50% of my profits off the table. The riskier the coin, the more aggressive you are with profit taking. The safer the coin, the less aggressive you are with profit taking. By having a predetermined, before you even buy, incremental profit taking system, you lock in the fact that you're going to make gains. That is the first part of the framework. The second part of the framework is invalidating to the downside. So I might be wrong about the bull run. You might be wrong about the bull run. So we need downside protection as well. I also have at key high time frame levels on every single purchase that I make, and I also have a max drawdown percentage on every purchase that I make, levels where I will invalidate my position if the market turns against me. Now, invalidation does get a bit complex because this makes up a portion of my de-risking, but the other portion is going to be at predetermined levels, aka, okay, there's a key support level at Bitcoin at, let's say, 95K. If it closes below on the weekly at 93, based on the low time frame price action and response to that level and the macro factors at the time, I'll look to de-risk and invalidate. You can also have hard stops on an altcoin. If you buy it at $1, you can say, okay, if it goes to 90 cents, it's a hard stop. That's okay too. Whatever helps you have a downside limit to your portfolio, because so many people, they trade with no downside limits, and that's how you get these situations where they run up their portfolio and then they run it all the way back down because they never had any downside invalidation. Before you buy a coin, make sure you have downside invalidation, and then you never need to worry. You can always get back in on the reclamation of a trend. Now, part 3 of this video, I want to talk about my mental framework heading into this last phase of the cycle, because I see so many people making this clear mistake. That mistake is, as the cycle goes on, they actually deploy more capital as the market goes up and up and up. So they take on more nominal risk as the market goes up. What you should do instead is you should actually dial down the stakes. So as the cycle goes on, gamble less money, put more money in stablecoins, but the bets that you do take, dial up the risk. So you're taking riskier bets with less capital instead of safer bets with more capital that you would look to take in a bear market. The bear market accumulation playbook is you get into safer assets like Bitcoin and Ethereum with more capital. The bull market late stage accumulation playbook is you use less capital on riskier plays to get higher beta exposure to the market. So as the bull run progresses, every single month, you should have nominally less money invested in the market compared to your stable coins. So by the end, you're heavier in stables, but maybe the coins you do hold to make up and balance out that barbell are by nature slightly riskier. That is the way to think about this last phase in the cycle. I'll repeat it once again. You want to dial up the risk in terms of the assets you're betting on, but you want to dial down the amount of dollar exposure that you have to the market. Overall, that constitutes my playbook for the remainder of this crypto cycle. To summarize, I use the 80-20 rule in my portfolio. I have stable coins on the side to take advantage of positions. In terms of exiting, I have targets to the upside where I'll ladder out of positions, and I'll also have invalidation to the downside in the event that I'm wrong, or to signal the end of the bull run so I can actually get some additional capital out of the market beyond the upside price targets, which at that point may have already been hit. And then finally, the way I'm thinking about it is dialing up the risk in terms of my bets. That's why I'm, as I mentioned earlier in the video, making some risky bets at the moment in that 20% of the portfolio, because now's the time to do it. But I'm also trying to overall keep increasing my relative stablecoin weighting versus the rest of my portfolio as the market continues to head into this euphoria phase. Remember, the real fun in the market doesn't begin until ETH puts in a new high, and that is yet to happen yet. So there's still a lot to look forward to, but I believe this video will act as a nice bedrock for you to be able to manage your overall strategy in this next period of the market. Make sure to subscribe to this channel to be kept in the loop, and I will see you in the next video. Have a lovely rest of your day. Peace out.